Hello, everyone. This is Ken Enriquez, and welcome to our next session in the accounting cycle. In our previous discussions, we explored financial statements, how they are structured, interconnected, and why they matter. But how do we get from everyday business transactions to a well organized financial statements? That journey begins with journalizing, which is the first step in the accounting process. Journalizing is the process of recording financial transactions in the accounting journal, ensuring that every business activity is properly documented. In this session, we will cover three main topics. One, the steps in journalizing. Two, the common mistakes in journalizing, and have some practice problems. By the end of this session, you will have a strong foundation in recording financial transactions, a skill that is critical in preparing accurate financial statements. Let's get started with journalizing, the first step in the accounting cycle. Now that we have introduced the topic, let us dive deeper into what journalizing actually means and why it is a crucial part of the accounting cycle. Journalizing is the process of systematically recording financial transactions in an accounting journal before they are transferred to the ledger. It acts as a first step in ensuring that business activities are properly documented. This process follows the double entry accounting system, which means that every transaction impacts at least two accounts. One side will always have a debit while the other will have a credit. For example, if a company purchases office supplies on credit, the supplies account, which is an asset, will be debited, while the accounts payable account, a liability, will be credited. This keeps the financial records accurate and balanced. By journalizing transactions correctly, businesses maintain clear financial records, making it easier to track expenses, income, and financial position. In the next section, we will go step by step through the journalizing process, ensuring you know how to properly record transactions. Let's get started. Now that we understand what journalizing is, let's go through the three key steps in recording financial transactions in the journal. The first step is to identify the transaction. The second step is to analyze the impact on account. The third step is to record the entry in the general journal. Mastering these three steps, identifying, analyzing, and recording, is essential in keeping financial records organized and error-free. We will discuss each steps thoroughly in the next videos. The first step in journalizing a transaction is to identify the nature of the transaction and the accounts involved. Every financial transaction falls into a category such as a sale, purchase, or expense. Let's break this down further. When analyzing a transaction, ask yourself, is it a sale? If so, it typically involves cash or accounts receivable and sales revenue. Is it a purchase? Purchases usually affect cash, accounts payable, or an asset account such as inventory. Is it an expense? Expenses involve cash or accounts payable and an expense account like rent, utilities, or salaries. Whereas these steps is described under determining the nature of the transaction. Then, you need to identify the accounts involved. Each transaction must involve at least two accounts to follow the double entry accounting system. Here is a quick guide. Sale transactions. If the company receives cash from a customer, the accounts involved are cash, which is an asset debit, and sales revenue, which is a revenue credit. If the company sells on credit, it affects accounts receivable, which is an asset debit, and sales revenue, which is a revenue credit. Purchase transactions. If you buy equipment and pay in cash, the accounts involved are equipment, which is an asset debit, and cash, which is an asset credit. If you purchase on credit, it involves equipment, which is an asset debit, and accounts payable liability credit. Paying rent in cash would involve rent expense, expense debit, and cash, which is an asset credit. Paying utilities on credit would involve utilities expense, expense debit, and accounts payable liability credit. These three are all under sales transaction, purchase transaction, and the expense transaction. Note on non-recordable transactions. Not all business activities are recordable transactions. If only one account is affected, it is not a valid journal entry. For example, if a company decides to hire a new employee but has not yet paid wages, there's nothing to record. It would just be a note in management records, but not a financial transaction. So before recording anything, always identify the nature of the transaction and determine the accounts involved. In the next step, we will analyze how the transaction affects the accounts and whether it should be debited or credited. Let's move forward. Once we have identified the transaction, the next step is to analyze its impact on the accounts using the accounting equation. Assets is equal to liabilities plus the equity. Every transaction must keep this equation balanced, meaning that if one account increases, another must either increase or decrease accordingly. To analyze a transaction correctly, we need to know which accounts are debited and which are credited. Let's go over how different accounts behave when they increase or decrease. Assets like cash, inventory, and accounts receivable, when they increase, they are debited. When they decrease, they are credited. Example, if a business buys equipment, the equipment account increases and is debited. If it is paid in cash, the cash account decreases and is credited. Liabilities like loans and accounts payable is credited when they increase, and when they decreases, they are debited. If a company takes out a loan, liabilities increase and are credited. When the loan is repaid, liabilities decrease and are debited. Equity accounts such as owner's capital and retained earnings, they are credited when increase, and when they decreases, they are debited. Example, when an owner invests capital into the business, equity increases and is credited. If the owner's withdrawal funds, equity decreases and is debited. Revenues like sales or service income, they are credited when they increase and debited when they decrease. Example, if a business earns revenue from sales, revenue increases and is credited. If revenue is overstated and corrected, it is debited to reduce the balance. Expenses such as rent, salaries, and utilities are debited when they increase and credited when they decrease. If a company pays rent, The expense account increases and is debited, while cash decreases and is credited. By applying these rules, we can correctly structure journal entries, ensuring that each transaction is properly recorded and the accounting equation remains balanced. In the next step, we will learn how to record the transaction in the general journal. Let's move forward. Now that we have identified the transaction and analyzed its impact on the accounts, the final step in journalizing is recording the entry in the general journal. A journal entry must include the following key details: date of the transaction, debit account and the amount, credit account and the amount, and a brief description of the transaction. This will ensure that each transaction is properly documented before being transferred to the ledger for further processing. Let's take a look at the format of a journal entry. On January 1, 2025, the company received $50,000 in cash from a customer for a previous sale made on credit. Here is how we record it in the general journal. Under the date, January 1, 2025, and under the debit, we have cash, 50,000, since cash is increasing, and credit account receivable, 50,000, since the customer's outstanding balance is reduced. The debit entry is always listed first, following by the credit entry, which is indented for clarity. This standard format helps maintain consistency and readability in accounting records. Journalizing is the first step in recording financial transaction and is crucial for maintaining accurate financial records. Proper journal entries ensure that all business activities are systematically documented and can be easily traced back when preparing financial statements. In the next session, we'll take this a step further and explore how transactions flow into the ledger and trial balance. Now, let's go through an example of a journal entry step by step. The transaction states a company purchases supplies on credit for $500. So let's break it down using the steps we have discussed earlier. Step 1: Identifying the transaction. What is the nature of the transaction? This is a purchase transaction, meaning the company has acquired something, specifically supplies. What are the accounts involved? The accounts affected in this transaction are supplies, which increases since the company is acquiring an asset, accounts payable, which also increases since the purchases was made on credit. The key term here is on account, which indicates that payment will be made at a later date. Step 2: Analyzing the impact on accounts. Which accounts are debited and credited? Let us apply the accounting equation. Supplies is an asset, and when asset increase, they are debited. Accounts payable is a liability, and when liabilities increase, they are credited. Here is how the entry will look like in the general journal. This is composed of the date, the account title, and the amount debited and credited. Please note of the indentation of the accounts payable below supplies. When this happens, supplies means debited and the indented one, which is the accounts payable, is the credited one. Since the company received supplies, we debited supplies for 500 since we did not pay cash and instead owe the amount, we credited accounts payable for $500. Every transaction must have at least one debit and one credit, which follows the double entry accounting system. The debits must always equal the credit to keep the book in balance. Look out for any keywords in transactions like on account, which indicates accounts payable, or paid in cash, which indicates payment in cash. Now that we have covered the process of journalizing, let us talk about some common mistakes that accountants and students often make, and more importantly, how to avoid them. Number one, reversing debits and credits. One of the most frequent mistakes is flipping debits and credits in a journal entry. Remember, assets and expenses increases with a debit and decreases with a credit. Liabilities, equity, and revenue increases with a credit and decrease with a debit. How do we avoid that? Always double check the accounting equation before recording the transaction. Use a chart of accounts to ensure the correct classification. Number two, omitting the transaction description. A journal entry is not complete without a brief description or explanation of the transaction. Leaving it out can create confusion later when reviewing records. How to avoid it? Always include a short, clear explanation of the transaction. Example, instead of just recording supplies, add a note like purchased office supplies on credit. Third, using the wrong account in the general journal. Sometimes, transactions are recorded under the wrong account, which can lead to incorrect financial reports. This usually happens when there are similar account names, like for example, supplies versus inventories, accounts receivable versus notes receivable, office equipment versus furniture and fixtures. How to avoid it? Be familiar with the chart of accounts used by the company. If in doubt, consult the ledger or financial guidelines before recording. Fourth, forgetting to record a transaction. Forgetting to record a transaction can lead to incomplete financial statements, missing revenue, or unrecorded expenses. How to avoid it? Use a systematic process to ensure all transactions are recorded. Perform a periodic review of financial records to catch missing entries. Cross check with bank statements, invoices, and receipts. Avoiding these mistakes will help ensure accurate financial records and prevent errors that could impact business decisions. Journalizing is the foundation of proper accounting, so it is important to get it right. One of the most common mistakes in journalizing is reversing debits and credits. Let's go through an example to see how this happens and how to avoid it. Example transaction. A company pays rent of $1,000. However, an error occurs in recording the journal entry. The mistaken journal entry, in which includes debiting the rent expense and crediting cash, the entry mistakenly debits cash and credit rent expense. This incorrectly implies that the cash is increasing when in reality it is decreasing. Mistaken entry is debit cash 1,000 and credit rent expense $1,000. The correct journal entry should be rent expense debit. Since rent is an expense, it should be debited to reflect an increase in expense. Cash is credited since cash is being paid. It should be credited to reflect a decrease in asset. So, the correct entry should be debit rent expense 1,000 and credit cash $1,000. How to avoid these mistakes? Here are some tips to ensure that your debits and credits are recorded correctly. 1. Apply the accounting equation. Always check if the transaction follows the equation assets is equal to liabilities plus equity. 2. Understand account categories. Asset and expenses increase with debits and decrease with credits. Liabilities, equity, and revenue increase with credits and decrease with debits. 3. Double check before recording. Before finalizing your journal entry, ask yourselves, is the account increasing or decreasing? Should this be a debit or a credit? A quick review before posting can prevent costly errors in financial report. By keeping these key points in mind, you'll minimize errors and ensure your financial records remain accurate. Let's move on to the next common mistake. Another common mistake in journalizing is omitting the transaction description. Let us discuss why this is a problem and how to avoid it. Why is this a mistake? Every financial transaction should have a clear purpose. If the description is missing, it creates confusion about why the transaction happened. Without a proper explanation, it becomes challenging to trace transactions, especially during audits. This can lead to delay, errors, and even compliance issues. Example scenario. Let's say a company records the following journal entry without a description: debit cash 5,000, credit account receivable 5,000. At first glance, it is unclear why this transaction was made. Was it a customer payment, a loan, an asset sale? Without a description, anyone reviewing the records would have to spend extra time investigating. How to avoid this mistake? Always include a brief but clear explanation. Instead of just writing the amount, add any context. For example, to correct the journal entry with description, we should debit cash 5,000, credit account receivable 5,000, then add a description. Received payment from customer for invoice number 1234. Be concise but informative. Mention what the transaction is for. Include details like invoice numbers, vendor names, or specific accounts. Think about future audits. A well documented journal entry saves time and prevents confusion when reviewing records later. By making sure every journal entry has a proper description, we maintain clarity and accuracy in the financial records. Another common mistake in journalizing is using the wrong account. This can lead to misclassification in financial statements and inaccurate reporting. Let us discuss how this happens and how to avoid it. What is the issue? Choosing the wrong account when recording transactions can have significant consequences. It can impact financial reporting, tax calculations, and even business decision making. For example, if you purchase office furniture but record it under office supplies instead of furniture and fixture, you are incorrectly categorizing a fixed asset as a short term expense. Example scenario: transaction when the company purchased office desks for $3,000. Mistaken journal entry: we debited office supplies 3,000 and credited cash 3,000. Since office furniture is a long-term asset, this misclassification will cause incorrect expense calculations and affect depreciation accounting. So, the correct journal entry should be debit furniture and fixture 3,000 and credit cash 3,000. Why does this mistake matter? Misclassification can lead to incorrect financial statements, which the company might overstate or understate expenses. Errors in depreciation calculations, where the fixed assets like furniture should be depreciated over time while supplies are expensed immediately. And Compliance issues. If the account don't align with accounting standards, financial statements may become unreliable. How to avoid these mistakes? First, understand the nature of the transaction. Is it a short term expense or a long term asset? Does it need to be depreciated over time? Second, review account classifications. Office supplies are consumables like paper, pens, and ink. Office furniture, computers, and large equipment are considered fixed assets. Third, verify before recording. If unsure, consult the company's chart of accounts or accounting guidelines. By carefully analyzing which account best represents the transaction, we ensure accurate financial reporting and avoid costly mistakes. One of the most common yet overlooked mistakes in journalizing is forgetting to record a transaction. This can lead to significant discrepancies in financial statements and affect decision making. What happens when a transaction is not recorded? Imagine a company receives cash from a customer, but the accountant forgets to record it. What happens? The cash balance is understated, meaning the company appears to have less money than it actually does. Revenue is also understated, which can distort financial performance. It may cause errors in tax filings or audits since income is not properly recorded. Example scenario. Let's have this transaction. A customer pays $1,500 in cash for a product. The correct journal entry should be debit cash $1,500 and credit sales revenue $1,500. If this transaction is forgotten, the company's reported revenue will be lower than its actual earnings. The cash balance won't reflect the payment. Financial reports may mislead stakeholders, affecting future decisions. How to avoid this mistake? First, always maintain proper documentation. Always collect invoices and receipts for every transaction. Second, use a systematic recording process. Set up a daily or weekly reconciliation to cross check records. Third, implement accounting software. Automating entries reduces human error and ensures completeness. Forgetting to record a transaction may seem minor, but it can lead to inaccurate financial statements and compliance risks. By implementing proper documentation and verification process, we can avoid this costly mistake. Now, let us put our learning into practice with a simple journal entry example. Transaction. A company sells goods for $2,000 in cash. Step 1. Identify the accounts affected. Since the company receives cash, the cash account increases. The company also earns revenue from the sale, so the sales account is recorded. Step 2. Determine debit and credit. Cash, which is an asset, increases, so we debited $2,000. Sales revenue, which is a revenue, increases, hence credited $2,000. Step 3. Record the entry in the journal. Here's how we record it. Date January 1, 2025, and we debit cash $2,000 and we credit sales $2,000. Tips. Remember, debits increases assets while credits increases revenue. Always check your journal entries for accuracy before posting them to the ledger. Let us go through another journal entry practice problem. The transaction is a company pays $5,000 in salaries to the employees. Step 1. Identify the accounts affected. Since the company is paying cash, the cash account decreases. Since this payment is a company expense, the salaries expense account is recorded. Step 2. Determine debit and the credit. Salaries expense, which is an expense account, increases. That's why we debited $5,000. Cash, which is an asset account, decreases. So we credited $5,000. Step 3. Record the entry in the journal. Date January 1, 2025. Debit salaries expense $5,000 and credit cash $5,000. Tips. Expenses are always debited because they reduce net income. Always check that your debits and credits balance before finalizing your journal entry. Let us go through the last journal entry practice problem on this session. Let us have this transaction. A company takes out a loan of $10,000 from the bank. Step 1. Identify the accounts affected. The company receives cash, so the cash account increases. The loan creates a liability, meaning the loans payable account also increases. Step 2. Determine debit and credit. Cash, which is an asset account, increases, so we debited $10,000. Loans payable, which is a liability account, increases, so we credited $10,000. Step 3. Record the journal entry. Date January 1, 2025. So we debit cash 10,000, credit loans payable 10,000. Tips. Assets increases on the debit side while liabilities increases on the credit side. Always ensure that your debits equal credits before finalizing your journal entry. Great work! Keep practicing different journal entries to strengthen your accounting skills. Now, let us talk about why journalizing is such a crucial step in accounting. Journalizing is the foundation of accurate financial reporting. Every transaction a business makes, whether it is a sale, a purchase, or an expense, needs to be properly recorded to ensure financial transparency and accountability. Without proper journal entries, transactions can go undocumented, leading to financial discrepancies. Financial statements may be inaccurate, affecting decision making. Businesses may face audit issues due to missing or incorrect records. By consistently practicing proper journalizing techniques, businesses maintains 1. Accurate financial records, 2. Reliable financial statements, and 3. A clear financial picture for decision making. Remember, a well maintained journal is not just about compliance. It helps businesses track their financial health, plan for the future, and ensures financial stability. This wraps up our discussion on journalizing. Now that we have covered journalizing, let us move on to the next essential step in the accounting cycle, which is the posting. Posting involves transferring journal entries from the general journal to the ledger account. This process organizes financial transactions into specific accounts, providing a clear and structured view of each account's balances. In our next session, we will cover what posting is and why it is important, how to use ledgers and T accounts, a step by step guide to posting transactions correctly. So, stay tuned as we take our journal entries and bring them to life in the ledger. This section covers three key areas. One, steps in journalizing transaction, which involves understanding the process of identifying transactions, analyzing their impact, and recording them correctly. Second, examples of journal entries, which includes hands-on examples to illustrate how different transactions are recorded. And lastly, common mistakes in journalizing and how to avoid them, which discusses errors and learning best practices for accuracy in bookkeeping. Journalizing transaction is the foundation of accurate financial reporting. By mastering this step, you ensure that financial records are precise and reliable. But journalizing is just the beginning. Thank you for joining on today's session. Make sure to practice journalizing and stay tuned for our next lesson. See you next time.